Trump's big beautiful bill promises huge tax cuts and economic growth, but is it really a win for America, or could it leave millions worse off? Stay tuned as Money Smart Basics reveal how this bill could impact your wallet and the entire US economy. Remember to like and subscribe for more Money Smart Basics videos. If you have any suggestions for financial literacy topics, please leave a comment. Stay until the end to receive a bonus tip. The big beautiful bill, signed into law by President Trump on July 11, 2025, is being hailed by its supporters as one of the most ambitious pieces of economic legislation in recent memory. The signing ceremony, held in the Oval Office, was attended by key congressional leaders, business figures, and members of the media, all eager to witness what many are calling a turning point for American fiscal policy. This bill marks a major shift in U.S. economic policy, signaling a renewed commitment to pro-growth strategies and a reimagining of how the government interacts with both businesses and everyday Americans. At its core, the legislation aims to reduce taxes for both individuals and corporations, slashing rates across multiple brackets. The hope is that by putting more money back into the pockets of Americans and businesses, the economy will see a surge in spending, investment, and job creation. The underlying bet is simple. With more disposable income, consumers will spend more, and businesses will have greater resources to expand, hire, and innovate. This, in turn, is expected to create a ripple effect throughout the economy, boosting growth at every level. Built on the principles of supply-side economics, the bill revives and expands upon the tax cuts first introduced during Trump's earlier term. It not only extends those cuts but also introduces new incentives for investment, entrepreneurship, and domestic manufacturing. Supporters argue that these changes will create a friendlier climate for both businesses and consumers, making it easier for small businesses to thrive and for families to keep more of what they earn. However, the sweeping changes have sparked fierce debate across the country. While advocates tout the potential for economic growth and job creation, critics are quick to point out the risks, especially when it comes to the nation's fiscal health. Many economists warn that the bill could significantly increase the federal deficit, especially if the promised growth fails to materialize. They caution that the fiscal risks could outweigh the benefits, particularly in a time of economic uncertainty. The bill arrives at a time when the national debt is already at historic highs, and global trade remains unpredictable. Lawmakers are now faced with the challenge of balancing immediate tax relief with the long-term need for fiscal responsibility. For many Americans, the question is whether the relief provided by the bill will be enough to offset rising costs and economic headwinds. Business owners, too, are weighing the benefits of lower taxes against the uncertainties of a changing global market. The legislation reintroduces several popular tax cuts, while also adding new incentives for savings, investment, and business expansion. Tax professionals are already working to help clients navigate the updated forms and regulations. As Congress continues to debate the bill's merits, the nation is once again engaged in a familiar argument about the proper role of government in managing the economy and promoting prosperity. As we break down the bill's provisions, we'll explore who stands to gain the most, who may end up paying more, and how the changes could impact Americans across the income spectrum, from middle-class families to the nation's wealthiest individuals. The financial markets are already reacting, with investors and analysts closely watching for signs of how the bill will shape America's economic future. Will it spark a new era of growth, or will it add to the nation's financial challenges? Ultimately, the big beautiful bill is more than just a tax cut. It's a bold economic experiment, one that will influence the nation's path for years to come. As its effects unfold, Americans from all walks of life will be watching closely to see whether this gamble pays off. At the heart of the bill lies a sweeping effort to provide direct tax relief for millions of individuals and families across the country. This isn't just a minor adjustment, it's a significant shift designed to put more money directly into people's pockets, especially at a time when many are feeling the pinch of rising costs and economic uncertainty. The goal is clear. By increasing take-home pay, lawmakers hope to encourage Americans to spend more freely, whether it's on everyday essentials, dining out, or making larger purchases. This boost in consumer spending is expected to ripple through the economy, supporting local businesses and helping to drive growth in communities nationwide. One of the most notable changes is the increase in the standard deduction, rising by $1,000 for single filers and $2,000 for those filing jointly. This move not only simplifies the tax process for millions, but also delivers meaningful savings, particularly for low and middle-income households who rely on every dollar. Seniors too stand to benefit with larger breaks on Social Security income. For many retirees living on fixed incomes, these changes could provide much-needed breathing room, helping them cover medical expenses, housing, or simply enjoy a more comfortable retirement. Another headline-grabbing provision is the temporary increase of the SALT deduction cap to $40,000 for 5 years. This is especially significant for residents in high-tax states where property and local taxes can take a big bite out of household budgets. For workers in the service industry, there's more good news. The bill allows employees to deduct up to $25,000 in tips, recognizing the vital role these earnings play in their livelihoods and offering a new layer of financial protection. Hourly and shift workers aren't left out either. They can now deduct up to $12,500 in overtime pay through 2028, a move aimed at supporting those who put in extra hours to make ends meet. Supporters of the bill argue that these changes will quickly inject more cash into American households, giving families greater flexibility to manage bills, save for the future, or support local businesses, ultimately fueling economic activity from the ground up. However, critics remain skeptical. Some question whether these tax cuts are substantial enough to drive real long-term economic growth, or if they'll simply add to the already mounting federal deficit, potentially creating challenges down the road. In the end, the true impact of these tax changes will depend on how Americans choose to use their extra cash, whether they decide to spend it, save it for a rainy day, or pay down existing debts. The choices made by millions of households will ultimately shape the bill's legacy and its effect on the broader economy. The bill's business provisions are designed to supercharge investment and job creation. Companies can now fully expense new equipment and R&D costs immediately, slashing upfront investment barriers. New deductions for building manufacturing facilities aim to revive American industry and keep jobs at home. Supporters argue these incentives will spark a wave of hiring, innovation, and productivity. The hoped tax savings will fund research, expansion, and new industries. Critics warn that businesses might use the windfall for stock buybacks or sit on cash, especially amid policy uncertainty. The real test? Will these breaks drive long-term investment or just pad shareholder returns? The bill's tax cuts come with a steep price: soaring national debt. With $4.5 trillion in lost revenue over a decade, and only $1.7 trillion in spending cuts, the U.S. must borrow heavily to fill the gap. This raises tough questions about fiscal responsibility and the burden on future generations. Higher debt could mean rising interest rates, making loans costlier for families and businesses. Tariffs are floated as a funding fix, but experts doubt they'll cover the shortfall, and warn of higher consumer prices and trade retaliation. The bill's reliance on borrowing sets up a risky fiscal future. To offset tax cuts, the bill slashes spending on Medicaid, food benefits, and green energy, totaling $1.7 trillion over 10 years. Defense and border security, however, get a boost, reflecting a shift in national priorities. Supporters see the cuts as necessary to curb government overreach and promote self-reliance. Critics argue they threaten vital safety nets and environmental progress, hitting the most vulnerable hardest. The bill's reallocation of resources ignites a fierce ideological battle over America's values. For some, it's fiscal discipline. For others, it's a transfer of wealth away from those who need it most. This clash defines the political fight over the big beautiful bill. The bill's central promise, robust economic growth, is hotly contested among experts. Skeptics like Filippo Pallotti argue the tax cuts are too narrow to spark real growth, especially with debt rising. Targeted breaks for tips and overtime may help some, but likely won't move the needle for the broader economy. Research groups warn that business investment remains sluggish, with uncertainty over tariffs dampening enthusiasm. Supporters envision a surge in hiring and expansion, but critics see companies hoarding cash or buying back stock. The outcome hinges on whether tax incentives can overcome trade fears and fiscal instability. The debate boils down to this: will lower taxes unleash growth, or will debt and uncertainty hold the economy back? Only time will tell if the bill delivers on its bold promises. Businesses now face a crossroads, tempting tax breaks on one side, trade uncertainty on the other. Full expensing and R&D incentives could drive a wave of investment, especially in manufacturing and tech. But unpredictable tariffs raise costs and cloud the outlook, making long-term planning risky. Many companies are holding back, waiting for clarity on trade before committing to big projects. The bill's success depends on which force wins, the pull of tax incentives or the push of global uncertainty. If trade stabilizes, investment could surge. If not, caution may prevail. Boardroom decisions in the coming months will reveal whether confidence or caution shapes America's economic future. Wall Street's reaction to the bill is both mixed and deeply revealing, offering a window into the complex psychology of today's markets. As news of the legislation broke, trading floors buzzed with speculation and uncertainty, reflecting the high stakes and divided opinions among investors. The bond market in particular has grown increasingly jittery. Higher government borrowing has pushed up yields, a classic signal that investors are growing uneasy about the long-term health of U.S. finances. Rising yields mean the government must pay more to borrow, and this has set off alarms about the sustainability of America's fiscal path. Meanwhile, the U.S. dollar has weakened noticeably. This decline reflects mounting doubts about the country's economic trajectory and the stability of its policy environment. Currency traders are watching closely, as a weaker dollar can ripple through global markets, affecting everything from import prices to international investment flows. Yet, in a striking contrast, the stock market tells a different story. The S&P 500 has surged to record highs, buoyed by investor optimism over anticipated corporate tax cuts and the promise of AI-driven growth. For many, these factors outweigh immediate concerns, fueling a rally that seems almost disconnected from bond and currency market anxieties. Some financial analysts are urging investors to keep their eyes on long-term fundamentals, emphasizing that short-term volatility shouldn't overshadow the underlying strength of the economy or the potential for innovation-led expansion. However, others are sounding the alarm, warning that persistent headwinds from rising tariffs and ballooning national debt could eventually catch up with the markets, dampening growth and eroding investor confidence. As a result, earnings forecasts have been trimmed by some firms, reflecting a more cautious outlook amid the uncertainty. Still, it's important to note that economic growth remains solid by historical standards, providing a foundation of resilience even as forecasts fluctuate. The sharp divergence between stock and bond markets highlights just how deep the uncertainty runs. Investors are grappling with conflicting signals, unsure whether to trust the optimism of equities or the caution of fixed income. In this environment, investors are carefully weighing the allure of short-term profit potential against the looming risks posed by long-term fiscal imbalances and policy shifts. Ultimately, the market's split verdict mirrors the nation's own debate over the bill's true impact, underscoring just how divided sentiment remains as America charts its economic future. The Big Beautiful Bill is a bold economic gamble, betting that tax cuts will spark growth strong enough to outweigh rising debt and social program cuts. Individuals and businesses get immediate relief and incentives, but the cost is trillions in new borrowing and reduced safety nets. The bill's fate depends on consumer spending, business confidence, trade policy, and debt management. Financial markets reflect the nation's uncertainty. Stocks are bullish, bonds are wary. The legislation embodies a vision of prosperity driven by the private sector and lower taxes. Whether this vision leads to boom or bust remains to be seen. As America embarks on this new economic path, the world is watching, and the stakes couldn't be higher. Congratulations, you made it to the end of the video. With that, you are ahead of 90% of most people in America. Here is the bonus tip that we promised. Don't wait for politicians to secure your future. Start building your own economic safety net now by diversifying your income and saving aggressively. The information provided in this content is for educational and informational purposes only, and should not be considered financial, legal, or tax advice. Always consult with a qualified financial advisor, tax professional, or legal counsel before making any financial decisions. The creator of this content is not responsible for any actions taken based on the information provided. Investments and financial decisions carry risk, and past performance does not guarantee future results.